The central bank in Canada is the Bank of Canada. It was established in 1934 and is currently being led by Stephen Pawlitz. In the US, the central bank is the Federal Reserve. And through 2017, it was being led by a woman named Janet Yellen. And in 2017, the new chair of the Federal Reserve will become Jerome Powell. Okay. So we have the Bank of Canada in Canada. The US has the Federal Reserve, but they have the same duties or purposes. And so we're going to look at the purposes of the Bank of Canada. So what is the Bank of Canada responsible for? Well, they are banker to commercial banks. They control the money supply. They're the official banker to the federal government. They manage our monetary policy, and they are supporters of the fiduciary monetary system. So let's break these down and look at each one individually. So the first purpose of the Bank of Canada is to be the banker to commercial banks. So our federally chartered banks, we said before, keep a fraction of their target reserve in the Bank of Canada. And the Bank of Canada can then lend them money if they need cash. Now, the Bank of Canada wants to be the lender of last resort. They want to be the last person that the bank goes to rather than the first. So we'd much rather have Royal Bank, for example, borrow money from CIBC than to have Royal Bank come to the Bank of Canada. So to do that, the Bank of Canada sets what is called an overnight target rate and a bank rate. So the overnight target rate is the rate at which banks borrow from each other. Oops. Whereas the bank rate is the rate at which banks borrow from the Bank of Canada. So if the Bank of Canada wants to be the lender of last resort, if they want Royal Bank to come to them only after they've gone to other banks, then how do these have to compare? The overnight target rate and the bank rate. Which rate would you set to be lower if you want banks to go to each other first than you want them to go to the Bank of Canada? Well, if you want banks to go to each other first, then this one has to be lower than the bank rate. So the overnight target rate is always 0.25% lower than the bank rate. This encourages banks to go to each other first. So let's look at what the overnight target rate and the bank rate are. So if we go to the Bank of Canada website, you can see that for November 2017, the overnight rate, the target for the overnight rate is 1%. Okay. So if our overnight target rate is 1%, then what would be the bank rate? What would be the rate at which banks could borrow from the Bank of Canada? Well, then that one would have to be 0.25% higher. So let's go back to our notes here. And I'll just scroll through just a second and I'll show you. So here you can see our bank rate and our overnight target rate and what's happened to them over the last decade. So you'll notice that the overnight target rate is always 0.25% lower than the bank rate. Okay. So we said that the overnight target rate right now is at 1%. So our bank rate is at 1.25%. We'd rather have banks borrow from each other than from the Bank of Canada, because the Bank of Canada wants to be the lender of last resort. Well, we'll come back to these graphs later, so pardon the scrolling. Let's just go back here to these slides. So the Bank of Canada is the banker to commercial banks, those federally chartered banks. So we can lend them money if they need cash. The other thing the Bank of Canada does is it sets the target reserve. Now remember, the Bank of Canada currently has the target reserve ratio at 0%. But the Bank of Canada could decide to raise that target reserve ratio, for example, if the economy was growing too fast and they wanted banks to hold more cash, and we wanted to slow down the amount of bank lending, decrease the money supply, decrease the amount of loans, decrease demand for goods and services, and slow the economy down. So right now we have a target reserve ratio of 0, but the Bank of Canada could change that amount. So banker to commercial banks. The second purpose of the Bank of Canada is to be the controller of the money supply. If we have too much money in circulation, all right, so we're all flush with cash, your pockets are full of money. Well, if your pockets are full of money and we just have the same goods being produced, then now we have lots of money chasing after the same goods. So then how do we decide who gets the last good on the shelf? The last case of beer, the last car in the car lot, who gets it? Well, it's going to be whoever's willing to pay more cash. And so the more cash you have in circulation, the more flush we are, the more we have inflation. Okay, the prices of everything go up because we're just willing to spend all that cash that we have. And in fact, we see with countries that print a lot of money, like Zimbabwe, we looked at earlier this semester, it creates hyperinflation and has a really negative impact on the economy. So check out the Ascent of Money video that's on Blackboard, and that looks at hyperinflation as well. So it looks at what happens when you have too much money in circulation. There's also an issue if there's too little money in circulation. If we don't have enough cash in circulation, then you can't pay your workers. If you're a business and you don't have any money, you can't pay them and they're not going to work for you. And if people don't have access to cash, then they're not going to buy goods and services. So why does our business need to stay in operation if nobody's buying our stuff? So if there's not enough money in circulation, you get unemployment and your economy stops functioning. So too much money hurts your economy, too little money hurts your economy, which is why we need a central authority to make sure we don't have too much or too little. So the Bank of Canada is the only institution that's allowed to print money. The third purpose of the Bank of Canada is to be the banker to the federal government. So the federal government actually holds its bank accounts with the Bank of Canada. So when you pay your taxes, your tax money goes to the federal government, and the federal government puts it into a checking account that they hold with the Bank of Canada. If the government wants to spend more than they're bringing in tax revenue, so deficit spending, then the government needs to borrow money. And the way they do this is they issue a bond, which they sell to the Bank of Canada, and the Bank of Canada then gives them money. So remember, a bond is debt, and it's an IOU to pay you back later. So the government issues a bond, the Bank of Canada buys the bond and gives them cash. So the Bank of Canada is a fiscal agent. That is, they are involved in the financials for the federal government. They are essentially their bank. They hold their money, they lend them money. Okay. The Bank of Canada is also manager of the country's monetary policy. So when we talk about monetary policy, we're talking about the money supply and interest rates. The Bank of Canada sets two interest rates, the bank rate and the overnight target rate. Let's try this again. Can't spell today. The overnight target rate. So the bank rate, we talked about that before. What's the bank rate? That's the rate at which banks can borrow from the Bank of Canada. And the overnight target rate, what was that? Right, that was the rate at which banks borrow from each other. So in November 2017, the overnight target rate was 1% and the bank rate was 1.25%. We make the bank rate higher because the Bank of Canada wants to be the lender of last resort. So in monetary policy, the Bank of Canada sets the bank rate and they set the overnight target rate. They also determine the amount of money in circulation. Right? How do they do that? Well, they can print more banknotes. They can change the target reserve ratio. Okay, that's the amount the banks have to hold as cash. Because remember, bank lending changes the amount of money supply. They can also perform quantitative easing. So when we talk about changing the money supply, those were the four things that we've talked about. Print more money, bank lending, change the fractional reserve, and change quantitative easing. The bank lending, we change that by changing these interest rates. Now, when you go and you borrow money, you're not paying the bank rate or the overnight target rate. You're probably paying prime plus or minus some percent depending on your credit. Okay, so prime is kind of the benchmark when banks lend to you. Well, prime is not set by the Bank of Canada. Prime rate is set by the banks. But the prime rate depends on the bank rate and the overnight target rate. Because the easier it is for your bank to borrow money, the cheaper it is for them to lend you money. If it's harder for your bank to borrow money, then they're going to charge you more to lend you money. So the prime rate, while not set by the Bank of Canada, is tied to the bank rate and the overnight target rate. So we'll show you here this relationship. So here you have your bank rate, right? 0.25% higher than the overnight target rate. And this shows you 1996 to 2006. And notice the prime rate. The prime rate moves with the bank rate and the overnight target rate because if it's expensive for your bank to borrow, it's going to be expensive for you to borrow. If it is cheap for you to borrow, if it's cheap for your bank to borrow, it's going to be cheap for you to borrow as well. So notice how they move together. And we can even look at more current data. So here's the last decade, and you can see the overnight target rate and the bank rate, and then here you can see the prime rate. So notice that when the bank rate and the overnight target rate went up, the prime rate went up as well. So if we look at the current prime rate, okay, we can actually go back to that website at the Bank of Canada. And you'll see here the prime rate, just the one above it, for November 2017 is at 3.2%. Okay. So it very much moves with the bank rate and the overnight target rate, but the only ones that the Bank of Canada sets are these two, the bank rate and the overnight target rate. Now we have a system designed, so let's go back to the slide here, where the Bank of Canada should operate independently from the federal government, right? The federal government manages the fiscal policy, the Bank of Canada manages the monetary policy. And monetary policy is money supply and interest rates. Now, it's not a completely independent process. The Bank of Canada is subject to approval by the federal government. So governors of the Bank of Canada, so Stephen Pawlett, is appointed for a 7-year term, but he can be dismissed or fired by the Prime Minister. If the Prime Minister disagrees with the central bank, then the Minister of Finance can actually mandate that the bank change its policy. So in the system that we have, the federal government and the Bank of Canada, we want them to operate independently, but they don't have to. The federal government and those who manage the fiscal policy can make mandates and requirements for what happens with monetary policy. Now, this has never happened so far in the history of Canada. The federal government, who's managing the fiscal policy, has never dictated to the Bank of Canada what their policy should be. There is some concern that it could happen. The risk with it happening is that you have the federal government, who mandates fiscal policy, could decide, for example, to cut taxes and increase government spending and just have a whole lot of deficit spending, accumulate huge amounts of debt. And then they could go to the Bank of Canada and say, you know what, you need to do more quantitative easing, you need to create a lot more money for us, so print money so that we have the cash to spend. We're going to issue government bonds, you need to buy them and create the money to do so. This could wreak havoc on our economy and get us into the situations that we see with Zimbabwe, with Argentina, with huge hyperinflation. So ideally, we'd like our monetary policy and our fiscal policy to be set separately so that our government can't just rack up huge amounts of debt and our bank can't just print tons of money and create hyperinflation. We'd like them to act independently of one another. But in our current system, that's not guaranteed. So if you're looking at your own economy and setting it up, would you have them be separate, or would you have them fall under? Now, one of the reasons that we might want to have our government where the federal government sets who's in charge of monetary policy, right? So the governor of the Bank of Canada is appointed by the Prime Minister. We might want to have the federal government, who manages fiscal policy, to have some authority over the Bank of Canada, is so that they're in alignment in terms of the agenda. So, for example, if the federal government is using fiscal policy to stimulate the economy, we'd want monetary policy that also stimulated the economy. It becomes ineffective if you have fiscal policy that's trying to stimulate the economy and monetary policy that's trying to slow down the economy, right? You don't want them working against each other, which is why in our current system, that's why the monetary policy is subject to approval by the federal government. So that if we're trying to stimulate the economy, we're increasing the money supply, we're decreasing the bank rate and the overnight target rate. At the same time, we're increasing government spending and lowering taxes, so that they both boost the economy and not counteract each other. All right, so when we talk about the purposes of the Bank of Canada, we said that the Bank of Canada was banker to commercial banks, controller of the money supply, banker to the federal government, and manager of the country's monetary policy. So the last purpose of the Bank of Canada, so that puts us at number 5, is to be a supporter of the fiduciary monetary system. The word fiduciary means in trust, holding in trust. So the Bank of Canada's purpose is to create confidence or trust in our money and our monetary system. We need to be confident that the money you get paid today will buy things tomorrow, and that if you're accepting that currency, that you can do something with it. Okay, so we have to have faith in the system. So the Bank of Canada is there to protect bank runs, to protect you from when you go to your bank to pull money out at the teller or the ATM machine, to make sure that that money you need is there. So how do we do that? Well, for our federally chartered banks, we have the Canadian Deposit Insurance Corporation. In the US, they have the Federal Deposit Insurance Corporation. So both of these insure bank accounts. In Canada, the CDIC, the Canada Deposit Insurance Company, it insures personal bank accounts up to $100,000 per account. So if you bank with Royal Bank and Royal Bank goes under as a company, then Royal Bank is insured by the CDIC, and for every bank account you have, you will receive up to $100,000, right? So if you had $50,000 in the account, you'll get $50,000. If you have $200,000 in your account and your bank goes under, you'll get $100,000 per account. In the US, the FDIC insures $250,000 per person per bank. So it's not per account, it's per individual. So if you had $50,000 in a bank in the US and it's a federally chartered bank, you would be covered $50,000. If you had 3 bank accounts in a bank and they each had $100,000 in them in a federally chartered bank in the US, then you would get $250,000, not $300,000. So the idea is that if your bank goes under or your bank runs out of cash, then you are protected. Your money is still there. If you live in Canada, because you are insured up to $100,000 per account, you probably don't want to put more than $100,000 into any personal bank accounts because you won't recover more than $100,000 if your bank goes under. In the US, since you're insured $250,000 per person per bank, you probably, if you have more than $250,000, want to put the next $250,000 in a different bank. So this is to create trust or confidence in the system that if your bank goes under, you'll be protected. The last time we saw this as an issue was in 2008 in the US. There were a number of banks that went under, right? People went to their banks to pull money out one day and the bank was just closed. Doors were locked. And so then in that case, the FDIC, the Federal Deposit Insurance Corporation, had to step in and give people their money. And of course, they got $250,000 per person per bank. So when we look at the purposes of the Bank of Canada, let's just recap. The Bank of Canada is the banker to the commercial banks. They control the money supply. Okay. So remember, when we talk about the money supply, we're talking about there's 4 ways to change the money supply. Print more, bank lending, and when we talk about bank lending, we're changing the bank rate or the overnight target rate. We have a fractional reserve banking system, so we could change the target reserve ratio or use quantitative easing. The Bank of Canada is banker to the federal government. They're also manager of the country's monetary policy, so they don't just change the money supply, but they also change that overnight target rate and bank rate. They do not change the prime rate. And lastly, they're supporter of the fiduciary monetary system. They're to create faith or trust in the system, and they do that by ensuring banks, those federally chartered banks, are protected so that you can have confidence in your banking system. What if you bank with a bank that's not a federally chartered bank? Well, if you bank with ATB, then they are also insured, okay, but through the province. And if you bank with a near bank, like Service Credit Union, they are privately insured. So if the bank goes under or runs out of money, then there's protection there as well, but it's through private insurance. In order for those types of banks to even be competitive against the Big Six, for example, then they have to provide similar insurance.